a bit on the oil and gas space. Jal Irani, the oil and gas analyst at Edelweiss Financial Services, now joins us. Good afternoon, Mr. Irani, and thanks so much for sparing the time and joining us on CNBC TV 18. You've just, come out with a report where you say that despite the fact that oil marketing companies have actually doubled in the last 1 year, the valuations appear compelling as well as the fundamentals are set to improve. So walk us through, how you see the oil marketing companies perform in the next 12 months, and what could be the fundamental drivers for them?
So the title of a report actually very aptly is Double or Quits. Double but no quits. Essentially, as you know, the sector in the past was akin to playing poker when reforms hadn't taken place. Essentially, in poker, as you say, you double or you quit. And now with reforms being firmly in place, we believe that although the stocks have doubled, we think that there is significantly greater scope from here. And there are essentially three reasons for this. We believe that the profits of these companies roughly over the next 3 years will roughly double because firstly, working capital requirements are down nearly 70% as the subsidy burden has declined, on the back of not only crude prices declining, but diesel, which was 60% of the subsidy burden, is now firmly deregulated. So reforms are actually structural, and hence is not playing poker anymore. And on the back of the diesel deregulation, we believe margins there are poised to double as well. Essentially, on a replacement cost basis for new entrants to come into the sector, the new players will require a margin of at least 1.5 rupees a litre versus 71 paise earlier, and that results in actually a significant growth in earnings as well. Notably, for the first 5 months of reforms, margins are already up by about 50% in that space. So that's our first argument. The second argument, which is more a concern that the market voices, is competition. We believe that competition, while being inevitable, is not going to play party pooper, because firstly their entry barriers are much higher, and to make a reasonable return they will also have to earn the higher margin, otherwise it just doesn't make business sense for them to enter the sector. And if you also go back to the 2002-2004 period, when you did have these reforms, competition did not actually fight on margins and actually allowed margins to go up, because it's still going to be a 5-player oligopoly. We've in fact done case studies of even very mature markets such as USA, and we've also done a case study of South Korea, which is a similar 4-player industry. And what we find is that in fact in the longer term, margins could be even much higher than what even we are anticipating. And finally, when it comes to valuations, despite these stocks having doubled, the valuations are not particularly stretched. So as a headline number, valuations stood at roughly about a 20% EV to EBITDA discount to, for example, the PSU basket. And again, looking back at the 2002-2004 period, while in those days these stocks had been 3 to 7 baggers, so as compared to that, doubling is still not significant. So really, putting all these three together, we are fairly bullish on the space because the reforms are structural and it's not playing poker anymore.
I know your point is taken, Mr. Irani, but one of the other points that you note is that it's the heavy inventory losses which have so far suppressed the benefits post the deregulation. So when do you actually expect the full benefits to go through, or for the OMCs to start trimming their inventories?
So in fact, that we've cited as an opportunity because the market doesn't recognize that so inventory losses are really a trajectory of oil prices. And as long as oil prices are declining, you'll get inventory losses. But that's purely technical. It's not fundamental. And in fact, because of those technical losses, so to speak, this year's earnings, so March ending 2015 earnings, we believe are going to be significantly lower, even though fundamentally the business from the retail perspective is actually doing much better. So actually the enhanced earnings are going to be masked as a result of that. We expect oil prices to remain actually weak roughly in till the middle of this calendar year and recover in the second half of next calendar year. So you'd to that extent you'll potentially get not only higher fundamental recovery and earnings from retail margins, but also inventory gains potentially into the next year, basically.
Okay. Mr. Irani, we've already seen about a 50% increase in the diesel retail margins. You indicated that you don't expect competition from private players like Reliance or perhaps even SR to play spoil sport. And diesel retail margins can actually go up, something that we've seen even in the global landscape. So give us a sense, how much can the retail margins go up from here in the next 1 year, 2 years, 3 years?
So, essentially, prior to deregulation, the margins were 71 paise a litre, and in the last 5 months, the margins roughly are about 1 rupee 10 paise a litre. Given essentially what the new players competition needs to earn, assuming a project IRR of about 11%. We believe that they will need to earn margins of about 1 rupee 60 paise a litre. So that's what we've assumed, that margins will settle down in the next 3 years. But if you take the Korea example, margins could be another rupee higher in the longer term. Of course, at this stage, we are assuming margins in about 3 years being about 1 rupee 50 paise to 1 rupee 60 paise a litre. But margins could be even beyond that, essentially. And, competition essentially has set up gas stations, 1,700 gas stations. This compares with HPCL, BPCL and IOCL have got 50,000 gas stations. By the end of this year, competition gas stations would be probably in the region of about 2,800 or so. But that again is not going to be very significant. So typically the nature of this industry is that the marginal player sets the nature of any business generally is that the marginal player sets the price, and in this case the marginal player are the new entrants whose cost of setting up these outlets is going to be higher.
Do you see FII interest now picking up in this space given the earnings upside that you project, and what would be your top pick in the sector?
Very sharply. I mean, if you look at the FI interest even in the December quarter, just after deregulation, just from memory, and don't hold me to this exact number, the FI holding in HPCL roughly has gone up by 6%. That's never happened before, and I wouldn't be surprised in this quarter, March, it's gone up even further. Now, why has that happened? I mean, this is one of the few large sectors that the government has opened up. And if you think of an analyst on the buy side who has got to pitch internally to his portfolio team, his investment committee, when you in the earlier days of control, when you have these companies where you cannot model them, where it is difficult to forecast earnings, it's difficult to actually pitch to your investment committee, and therefore difficult for the fund managers, among the FIs especially, to buy these stocks. Now that we've got reforms in place, and progressively as these companies become modelable, then they become like any regular business, and therefore they become significantly investable. And hence we see FI interest only going up. Now, we do have a buy on the entire space. That includes HPCL, BPCL and IOCL. To answer your question, HPCL in the near term will be the largest beneficiary because its retail ratio to its refining ratio is the highest. BPCL otherwise has got generally greater efficiencies and in the longer term will be a winner. So we'd essentially say, in the shorter term, HPCL will perhaps give you better returns, in longer term, BPCL.
Okay, and by the way, just a note for all our viewers, Edelweiss has upped the target price in all the three oil marketing companies. So for BPCL, it's 935, HPCL 816 from 781, and for IOC, it's 429. Very quickly, Mr. Irani, one final question. We've already seen structural reforms in the oil and gas space, as you pointed out. In the next 12 months, any more that we can expect in terms of reforms?
So the other set of reforms which is ongoing is LPG. LPG subsidy being brought down. Now, I mean, to that extent, so subsidies in the oil sector, the entire under recovery, as you may recall, was as large as 1,69,000 crores a couple of years back, and now it's down to, we estimate, about 42,000 crores by next year. Now, within that chunk, LPG now accounts for 60% of the subsidy burden, which also the rollout of the direct transfer scheme, to the bank accounts. The target for the government there, I believe, and I'm just telling you this number from memory, is about another 10,000 crore reduction in subsidy. That further enhances profitability of these companies. That's a significant reform. Interestingly, a bulk of the reform is in the downstream space, which one would have thought would have been more difficult to do, but actually that is being managed very well. The area of reforms where reforms are significantly required is actually upstream. We have seen global oil prices declining, and with a lag, equipment cost is crashing. So the service suppliers, for example, deep water rigs, and India's got a lot of deep water areas to explore. So deep water rigs are coming down from $500,000 a day, $0.6 million a day, to $0.3 to $0.35 million a day, so nearly halving. And it would be actually a very opportune moment to do reforms there, so that actually the country can take advantage of low services cost and boost the upstream sector requirements. Notably, by far, India imports 80% of its oil requirements, and which is the largest portion of its import bill. So I think that's an area of reforms which the government would do well to actually to kick off now.
All right, Mr. Irani, we'll leave it at that. Thanks so much for joining in.